Wall Street is projected to spend $660 billion on AI infrastructure in 2026. This chart tracks that capital expenditure against economic returns, which are currently flatlining near zero. Even with returns this narrow, the banking industry cannot stop spending. They are caught in a cycle where opting out of the technology is seen as a greater risk than the massive sinkhole of the investment itself. Data from McKinsey shows that 55% of working-age adults will be using generative AI by 2025. This adoption rate is moving faster than any previous technology in history, leaving banks with no transition period to adjust. Consumers are moving rapidly toward active reliance on these tools. 69% of users now trust an AI to provide complex financial advice over a human professional, largely because models like Claude are outperforming professional stock pickers in early testing. This shift has eliminated the traditional grace period for technological change. Banks are now forced into a technological arms race, where the goal isn't just growth, but basic survival in a market where consumers have already flipped their trust. Rather than building systems from scratch, the largest financial institutions are attempting to buy their way into the lead. Capital One recently followed up its $35 billion acquisition of Discover with a $5.15 billion deal for the fintech firm Brex. This acquisition was designed specifically to integrate Brex's AI-native corporate card and spend management platform into Capital One's massive banking scale. Other giants are embedding the technology directly into their existing systems. OpenAI's new $4 billion venture, DeployCo, is designed to place engineers inside client organizations to bridge the gap between models and data. BBVA and Goldman Sachs are serving as founding partners for this venture. Their goal is to connect OpenAI models directly to their internal enterprise data and business processes. The escalation has moved from simple assistance to total autonomy. Fiserv recently launched Agent OS in beta, a system designed to help banks deploy and scale autonomous AI agents across their core workflows. This strategy is a high-speed land grab. Wall Street is operating on the assumption that AI can be purchased at a premium and bolted onto existing banking operations to solve the problem of scale. Despite these massive multi-billion-dollar moves, the economic returns remain narrow. The technological investment is hitting a specific structural barrier. Currently, AI is highly successful at peripheral automation. At major banks, AI already drafts 95%. AI is allowed to handle peripheral tasks, but it is blocked from core settlement, the actual movement and clearing of money. This is due to systemic risk, the danger that an automated error in these core functions could trigger a collapse across the entire financial system. Banks rely on legacy infrastructure dating back to the 1980s, protected by intense governance liabilities. Because autonomous agents cannot legally carry the liability for a trade failure, they are barred from the most profitable parts of the business. Furthermore, geopolitical concentration risks prevent regulators from allowing AI to handle the core of the global financial system. AI is currently performing high-tech administrative busywork. It remains structurally locked out of the massive economic engines that actually generate revenue for the banking system. Facing this barrier, the industry is shifting its focus. Instead of aggressive expansion, the new priority is profitability and direct control over infrastructure. Many fintechs are now seeking traditional banking licenses. They want to own the underlying infrastructure directly, allowing them to rebuild the systems that currently block AI integration. This pivot isn't just happening in the private sector. National regulatory bodies are now directly funding AI infrastructure instead of just policing it. The UK's tax authority, HMRC, recently awarded a £175 million contract to the fintech Quantexa. They are using its decision intelligence platform to modernize the core data infrastructure used to identify tax risks. In the US, the House Financial Services Committee is advancing legislation to modernize how the government supervises the financial system. The Unleashing AI Innovation Act is a key part of this push. It creates regulatory sandboxes where banks can test AI and finance under a supervised framework, attempting to solve the liability issues that currently keep the technology on the sidelines. Regulators and governments are becoming active participants in this arms race. They are no longer just referees. They are now primary buyers and architects of the new system. There is also a push to protect this changing system from misuse. The Bank Fraud Technology Advancement Act was introduced to expand access to AI-powered fraud detection as these new systems come online. Parallel to this, the GUARD Act is designed to help law enforcement utilize blockchain tracing to investigate financial scams targeting the elderly. The global economy's operating system is undergoing an internal rewrite. It is currently caught between a $660 billion technological requirement and the immovable constraints of systemic risk. The next few years will determine if the banking system can successfully integrate these tools without compromising its core stability. As these market shifts continue, we will be tracking the data and the deals. Subscribe to stay updated on how the financial frontier is changing.